Welcome to The Explainer. Today, we're unpacking the absolute rock-solid wisdom of a guy who's basically the father of value investing, Benjamin Graham. We're going to explore a system that has profoundly influenced the greatest investors in history, including, Warren Buffett himself. But here's the real secret, and this might surprise you. This system, it actually isn't about being the smartest person in the room, not at all. It's entirely about survival over brilliance. It's about building this interlocking, bulletproof defense against losing your hard-earned capital.
Just listen to this striking analogy from Joel Greenblatt for a second. Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot, right? It completely captures why we're here today. We're here to put out that match. We want to stop the gambling, stop blindly chasing whatever trend is hot, and instead start building a robust, rational system based on Graham's bedrock principles.
Okay, let's dive right in. We've got a clear 5-part roadmap to systematically demystify value investing for you today. The mindset shift, meet Mr. Market, finding intrinsic value, the margin of safety, and finally, your circle of competence. All right, starting off with section 1, the mindset shift, speculation versus investing. Because look, before we look at any numbers or charts or anything like that, we literally have to fundamentally change how we view a stock in the first place. There is a stark, absolute contrast between these two approaches. Most people, they approach the stock market as speculators. They think they're just trading little pieces of paper based on what they guess somebody else is going to pay for them later on. It's totally a zero-sum game, heavily reliant on crowd psychology. But true Graham value investors, they see themselves as business owners. A share of stock represents a fractional ownership stake in an actual, living, breathing business. And this turns the whole thing into a win-win game of long-term value creation. So remember, you aren't a screen watcher. You are a business owner. Seth Klarman completely hits the nail on the head here. He says, once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. Avoiding where the crowd goes wrong is the absolute foundation of this mindset shift. Honestly, when you stop trying to predict crowd psychology and start focusing on the underlying reality of a business, everything else just looks incredibly, unbelievably risky. So now that we're thinking like business owners, let's move to section 2. Meet Mr. Market, your servant, not your master. Benjamin Graham came up with this brilliant allegory to show that the market is meant to serve you, not dictate what you do. Imagine you're partners in a private business with this deeply irrational, kind of manic-depressive guy named Mr. Market. Every single day, he comes up to you and offers to buy your shares or sell you his. Now, when he's euphoric, he quotes these wildly high prices. But when he's depressed, he's willing to sell you his share for absolute pennies. But the catch is, he always leaves the decision completely up to you. Your job as an investor is to exploit his rational exuberance and his deep despair, rather than ever letting his crazy moods influence your own. I love this. Warren Buffett actually once described the stock market as a drunken psycho, and he learned this directly from Graham. The key takeaway here is that emotions and psychological errors are the ultimate enemy of the value investor. You absolutely cannot let a drunken psycho tell you what your business is worth. You just stand back, observe his wild behavior, and wait for him to hand you an incredible bargain. But this brings us to a really fascinating question, doesn't it? If a business is relatively stable from day to day, selling products, paying employees, why on earth do stock prices swing so violently all the time? Why does Mr. Market fluctuate so wildly when the actual value of the company couldn't possibly have changed that fast? Well, Joel Greenblatt has this humorous yet profoundly true answer to that exact question. I don't know, and I don't care. Actually, that's the real beauty of it. As an investor, you don't need to waste a single second analyzing the psychology of the crowd to predict why these swings happen. You just need to acknowledge that they do happen and then simply take advantage of the mispriced assets when they pop up. So if we're gonna exploit Mr. Market's crazy prices, we actually have to know what a business is worth in the first place, right? That brings us to section 3, finding intrinsic value. Price is what you pay, value is what you get. The absolute crucial point here is that price and value are two very, very different things. Price is whatever Mr. Market is yelling today. Intrinsic value, on the other hand, is dictated by fundamental financial analysis. It's the actual discounted value of all the cash that the business will generate over its remaining life. So you have to sit down and do the math on the company's fundamentals instead of just following whatever the market trend happens to be. Graham famously compared this dynamic to a voting machine versus a weighing machine. In the short run, the market is just a voting machine.
It's a popularity contest driven purely by emotion, which is exactly why Mr. Market's prices bounce all over the place. But in the long run, it's a weighing machine. Eventually, the market has to assess the true, underlying fundamental weight or value of the business. Extreme patience is what allows that weighing machine to eventually reward you, the value investor.
Which takes us smoothly into Section 4, the margin of safety engineering survival. Now, what's really cool about this is that it isn't originally a financial concept at all. It's actually a concept borrowed straight from the world of bridge engineering.
Think about the logic here for a second. If an engineer is tasked with building a bridge and they know that a 10,000-pound truck is going to drive across it every day, they don't build a bridge that can hold exactly 10,000 pounds. No way. They build it to withstand 15,000 pounds. That extra 5,000 pounds is their margin of safety. It's a built-in buffer against bad calculations, material stress, or just unforeseen circumstances.
Warren Buffett beautifully connects this bridge engineering idea straight back to finance. He notes that valuing a business is, frankly, an imprecise art. You're trying to predict future cash flows in a totally unpredictable world. And because human beings make mistakes and bad luck absolutely happens, you cannot cut it close. You absolutely must leave yourself an enormous margin to absorb those inevitable errors.
Just like the engineer overbuilds that physical bridge, the value investor underpays for the stock. If you calculate a company's intrinsic value to be, say, $100 a share, you don't go and buy it for $98. You wait for Mr. Market to completely panic and sell it to you for $65 or less. That 35% discount, that is your margin of safety. It's a risk-averse mechanism designed specifically to prevent the permanent loss of your capital if your initial calculations were a little off. And that naturally leads us to our final section, Section 5, your circle of competence, the ultimate defense. You see, the margin of safety is incredibly powerful, for sure, but it literally only works if you're applying it to a business you actually truly understand. Operating within your circle of competence requires some deep, independent thought. Howard Marks calls this second-level thinking. First-level thinkers, they just look at the surface. They say, hey, it's a good company, let's buy the stock. But second-level thinkers, true value investors, they dig way deeper. They say, yes, it's a great company, but literally everyone knows that, which means the stock is totally overpriced and offers absolutely zero margin of safety. Let's look elsewhere. Going beyond that superficial, crowd-based thinking protects you, but only provided you strictly stick to what you know. I am obsessed with this analogy. It's the Babe Ruth effect. In baseball, if you don't swing at a pitch in the strike zone, you get a penalty, right? Strike one. But in the stock market, it is a no-called strike game. You can literally stand at the plate for years, watching thousands and thousands of companies fly by. There is absolutely no penalty for waiting. Extreme patience is a massive advantage here. You literally only have to swing your bat when a business falls perfectly into your circle of competence and is offered to you at a huge margin of safety. So, let's see how this all builds into an interlocking system. Charlie Munger, Buffett's longtime business partner, essentially views Graham's philosophy as a three-pillar defense system. First up is inversion. You figure out exactly how you could lose money, and then you just avoid doing that. Second is the circle of competence. You strictly filter out absolutely anything you don't understand. And third is the margin of safety. You build a massive buffer into the price you pay, just in case you were totally wrong about the first two. Which perfectly summarizes the entire philosophy of this explainer. The magic of Benjamin Graham's value investing isn't about being some Wall Street genius. It's about trying to be consistently not stupid. By acknowledging human fallibility, insisting on that margin of safety, and completely ignoring the manic emotions of Mr. Market, you survive. And in the investing game, survival and the avoidance of big mistakes is exactly what yields the greatest long-term compounding.
So I'm going to leave you with this to chew on. Take a really hard look at how you allocate your capital right now. Are you building a robust, engineering-like defense for your portfolio, or are you just blindly playing right along with Mr. Market's manic, zero-sum game? Thank you so much for focusing in with me today. Apply these timeless principles, always demand that margin of safety, and I guarantee you, your perspective on investing will never, ever be the same.